None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It is Monday morning after a short week. Probably too much golf for a lot of you. We decided we get tired of looking at Mitch's shirt, so we decided to just make him a floating head today. So you can't even see his shirt. He does have his favorite white shirt on now. Anyway, actually a lot going on. Last week was pretty significant as the breakout continued. A couple things I thought were noteworthy this morning that I was looking at. A couple tweets that I did. One which we'll talk about later when we talk about in the treasuries and interest rates, which was some things that are going on in the muni market that I think are pretty significant. And we've been long the muni market for a while. I think it's up almost 9%. Some of these funds are doing really, really well. But the other thing is the attack by the Obama administration through the EPA, attacking basically our electric grid, and he said he was going to try to put all the coal people out of business. So we'll see. I haven't looked at the coal stocks and things. Maybe I'll have Mitch while we're doing some other things. Look, see if we can find a couple of those.
I'll dig into it.
But my tweet said, could this be the camel that broke the straw back? The straw that broke the camel's back. Oh, it is Monday.
Right?
It is Monday. So these are the kind of things when you see any kind of increase in utilities, that's something everybody has to use. And that's even more significant, I believe, than gasoline in a lot of ways, just because, especially in the summertime, what a time to start the attack. I don't know exactly what the effects are going to be. None of us do, but I would suspect if there's going to be a carbon tax penalty. And I read a book several years ago I thought was really interesting, and I keep seeing maybe this is I didn't think it was necessarily a liberal book, but a more of a futuristic look forward. It's been compared to almost like Adam Smith's book and forward looking from an economic standpoint and other areas. But they talked about I'm actually going to test drive a Tesla next week, and just looking at some of the new technologies and things that are out there, and they talked about in this book that cars would be basically like just a flat board with wheels, and that's exactly what a Tesla is. It's amazing how nothing on the frame and the chassis, how little there is there, and but that's exactly what they were talking about, and a lot of things of that sort. Then they also talked about having benefits of not using carbon. Otherwise, that the future would be about carbon usage, and the lack of, you would be rewarded as a company for not using carbon. So that's certainly, well, initially this may be a drag. It may cause some efficiencies that would, but in the intermediate term, there could be a hiccup in cash flows in the economy and other things that could cause, because these things don't turn around very easily. So when you force the horse to water and he doesn't want to drink, and then you force the water down him, sometimes it doesn't work out really well. But the whole bottom line is there's there's some things going on that can trigger some moves. It certainly isn't happening today. I don't expect it to be immediate of any sort, but I continue to always look for what are the things that are out there that could cause a shift in sentiment or any kind of changes in the markets. And some of these things happen. I mean, I remember maybe 2 months ago when the currency situation was going on with Turkey and some of these others. Well, that quickly dissipated. It felt very real at the time, and the markets are still in this crisis mentality. So they're looking all the time for something to happen. What's the next shoe to drop, and then something to respond to. And we see this over the over the course of the last 3 years, really going back to 2011. The sky was falling in Europe, and all the protection and all the selling that went on during that period of time, and the fear selling ended up to be nothing. In fact, I talked about this, I think, a couple of shows ago, that one of the best things you could have done is when the bonds in Greece were at 22%, you could have bought them. They're like 7 or 8 now. It's like a monster bond trade. It's like one of the best trades there was. Matter of fact, you could have bought all the peripheral of Europe, all the bonds back during that 2011, and that was what we should have been doing with our money, as it turns out. Hindsight's a wonderful thing, but our focus wasn't really on that and looking at those international markets, but certainly that was where it all was. And while the U.S. stock market did really well last year, this year we continue to struggle. And even though we're punching out new highs finally, the percentage gains are still pretty moderate. It all looks better than it really is to a point, because all of a sudden 4% of an index that's 1,930 is a lot. So you're looking at 101%, 190 points. So all of a sudden that's 500-600 points. Looks really good on the screen. Feels really good, but not really doing much. So that's more or less the kind of market we're in now, is that the percentage moves from a point standpoint looks like they are. So I won't babble on too much more about that, but I'm going to go over and we're going to start reviewing some of the activity here in the U.S. markets. It was interesting that we had I'm going to bring up this 5-minute chart here. You can see down at the bottom here is the cycles. We had a cycle come in just before the actual low in this 5-minute, and it just bounced off of that, went straight up. We were negative by 5.5 handles on the S&P, and it just snapped back. You can see here, once it stabilized, it was literally about 15 minutes. It went from negative to positive to basically flat on the day. We're up 73 cents at the moment. Not a lot going on, but the activity, it tells you, when you see these types of things, it tells you a lot about the character of the market, the underlying market. You'll see the same thing here. I'll bring up the hourly graph, and remember, this graph here is the 24-hour. Each bar on this chart is 1 hour, but it also runs 24 hours pretty much. I think there's one 15-minute break in the whole thing, but you can see the same thing here. Right as we had some cycles coming in on an hourly basis, you can see over here that this is exactly where this market came in and set up a low. So this right here, you can see the cycle. It's interesting though, is that this is not the type of usual climactic type pattern that we get when these hourly charts make a low. So my expectation, just looking at this, is off the cuff. And I do all this analysis live. I don't premeditate anything. So we're just kind of looking at the charts together and going through what's happening here. And you can see here that this bottom arrow here, I'll put another arrow, so arrow on arrow, shows that the swing index actually went positive here when the market was making a low. And typically when that happens, it usually brings a flat period. I'm just drawing a bar over here on the left. You'll see the swing index volume, rate of changes of the volume increase, and you got a swing index high, and then the market kind of went flat there before it did continue on. But this is the same pattern. I've talked about this whole drill line through this entire length of this pattern here, and this goes back to 520 at the lows roughly, and this has been the pattern that's been going on for the last several days here, close to 3.5, 4 days now. We've seen this pattern continue to evolve trading sessions, in the better part of 5. So this is not a lot to look at here, other than to understand what types of patterns that are unfolding as the market goes forward here. We're going to look at a couple of these charts real quick. This one's fairly significant. In fact, let me I'm going to turn off the models for right now so we don't have to look at that. Just clutters up the chart. But this pattern that's unfolding here, this is the weekly graph. This pattern is actually continuation of this uptrend. And now all of a sudden, since we started breaking out of this pattern back at the 1882 level, remember that number, 1882.60, once we finally got above that, this market's moved out of here pretty good. We printed up to, I think, 25 and change. Let's see here, 25.27 today, so 1925.27. Last week I was talking about the objectives of 1930 or 1920 to 1930. We're in that range. There was a pattern I'll show you in a minute that popped up that looks like this particular sequence could actually extend a little bit, but we'll take a look at that. So the weekly charts, the other thing you got, the VIX at 1177. It's about as low as that's been. It's been a little lower last week, but for the most part, that's about as low as that index has been for a while, which typically would tell you that we're getting a little frothy here yet, but that doesn't appear from the pattern standpoint to be the case. So let's go ahead and look at one more. That's a nice spike. We just need to refresh this data and that will go away. There you go. So this is a better chart that you can see what's going on. There's been that's SanDisk. So I thought that was the S&P. That's good. All right. It got reduced down a little bit here. Now we'll try that again. This is the S&P. This trend line, or the 10-week moving average, has continued to expand. I don't know if any of these numbers ring bells. I know we have a fairly we have a group of you that are pretty commonly on the system here every day. But if you look at the let me just bring up some of the numbers, and that's funny because I was wondering why I couldn't see. I don't have my glasses on, so bear with me if I squint. When I go off screen, I'll grab them and be able to see what's going on again here. But one of the things that we're looking at here is these averages continue to go up. Look at the PPM 1, 2, and 3. We'll do that review real quick on an intermediate basis, and you'll see PPM 1 now is 161, 139, and 1%. So they're still expanding. That number was close to it's increased a little bit, about 145. So they're continuing to increase. This spread on the moving averages that I'm drawing over on the right hand side of the screen, that expansion is still in place. So this thing, the PPM1 is tied to the 10-week moving average, which tells us it's moving the fastest and expanding against the 21 or the 10, the PPM2, which is 139. So you're looking at a still expanding trend, not a ending trend. So there's still some things when we look here in a minute on a weekly basis or on a monthly basis, but you'll see what I'm talking about. This overall trend on an intermediate basis is still expanding. It's not over, and this is from an index standpoint. We did see, we'll go through that. Mitch usually does the review and looking through the data on new buys and sells and those kind of things, but we did have some additional net buying going on We pushed the bullish percent up to 52%. So we'll go through that shortly when we get to the next phase of the show here. But this trend is expanding. That's all there is to it. It'd be nice. It's not, and that's funny. This is the monthly. I'm really on this morning. But this is the monthly. So this is the monthly numbers that are expanding. Let's go to the weekly and get to the right analysis. It's what happens when you don't have your glasses on and you're getting old. That definitely is the problem. Okay, so we'll try this again. So the ppm 1, 2, and 3 is 36, 21, and 0.04 or 0.4, all positive. So we're actually seeing still an expansion here on the intermediate basis as well, but not at the level that you see on a monthly graph like what we were just looking at. The objectives here, I've been rattling this a lot. Let me just bring up the whiteboard so you can see exactly what I'm talking about here. So there's 3 of them over here, and those are the 1973, which is the minimum objective, with the extreme objective range of 2034 to 2072, and that's only a 4 to 8% rally going up to those extreme levels. So like I said, numbers sound really big. 2072 sounds outrageous on the S&P, but it's really not. It's really just a 4% rally. So, but those are the current objectives. We talked last week a bit about each one of these stair-stepping objectives that has occurred as this market formation has continued to unfold. And one of the things in understanding these markets, I think a lot of people think technical analysis is trying to pick the top and figure out where the bottom is, and that's really not what it's about. It's about understanding what's going on, understand what the probabilities are, and the probabilities are still pointing to the upside. We have expanding monthly we just looked at, and that is calculated on what we know to be with today's pricing in there for the month of June. There's in TradeStation, when I'm doing this, every one of these, if we went to a short-term graph, every indicator, everything is updating in real time. It doesn't have to wait till the end of the day to update. And so this is all updating real time, and on the monthly graphs, we definitely are seeing that expansion. But it's the same thing that we've seen. All the PPMs are pretty much flat, even though they're expanding. They're off of their peak expansion levels that we saw earlier in the cycle, which is pretty typical. Everything is pretty much the same as it should be. We're looking at the daily models now. You can see the you can see that the expansion is occurring here. We're at 0.24 on ppm 1, which is right at the trend level. So what that means is that we're 0.25 is a trend, 0.1008 and 0.04. So what that suggests is that these moving averages, the 21 and 40, are pretty much flat. The 10-period moving average is actually up and supplying some sort of underlying support, which that number is 1902.77. Last night I talked about that if the 1915.30 level would be penetrated, then we would have a potential to going down toward this level, 1907 actually to 1902. The low today was 1915.98. So we held that support, which was the extreme support for the day, and the market bounced off of there very nicely, as I talked about. It's interesting from my viewpoint anyway, is that the daily range, the 3-day daily range, is at 8.23. So we're continuing to have very, very narrow ranges. We actually have had a bigger range already of 10 points roughly today, just a touch under 10. And so usually when we get to this contracted level, and this is actually one of the lower levels I've seen at 830, 823, that particular sequence usually means that we're about to have a big explosion in volatility. And we're looking at the VIX index I was talking about a minute ago at 11 in the 1120s, and we're looking at this contracting indicator from a daily range standpoint. So that usually when it gets really tight, there's about to be some sort of change. It doesn't really tell you whether it's up or down, but it does suggest that there's a change in volatility very close. And looking at the charts and everything, we'll go to one level that I usually don't go down to very often, but I have been doing it more often now. So I guess I won't say that anymore because I've been doing it more than not. Is looking at the hourly graph, and this is where the 1930/1938 range came in. You can see the same type of patterns going down to this level that we see in the other charts. You can see here there's 3 Fibonacci projections right now that are coming out of the VPM projection tool, and you're seeing all of these. Typically they'll go in between the blue and the cyan line, so we are the blue line is going to be is 1933. So today's extreme range on the upside is 1931.80. So we're pretty tight. The way that the market's traded, we could see a little minor surge. I don't think with the news that's coming out this week that we're going to see any significant moves from prior to really maybe the ADP report, or we come into Thursday, there's a couple of reports there, but it's back down to the first of the month, and unemployment numbers are going to dominate everything, and that'll be that. But from overall, just to summarize, going back to the weekly graph here, the trend is still expanding. We're still in trend mode for the most part on the shorter part of the intermediate trend, and then on the longer term trend, we're also looking at the ability for that to continue on with just the expansion in the PPM. So I'm in a process of getting my glasses so I can see. Hopefully this works out. Let's see. Oh yeah, nice. Okay. The next thing I want to go to as we go through the spectrum here, let's go ahead and take a look at the treasuries, which we continue to be somewhat dominant from the standpoint of that. And Mitch, would you do me a favor while we're going through this? Would you look up like a muni index or something I can look at, like some sort of a municipal index that would be good. So the treasuries, we're back at 253.70. We got down to 240. What was that number there? It was 240, almost 240 exactly. So we've bounced pretty good with the treasuries, which tells me that we are starting to see the bottom. I mentioned that we might go to 245. Well, we went to 240, and it looks to me, looking at the indicators, PPM1, all three of the PPMs here, is that you're looking at. Let's see if I'll come back on screen here now. I can see what's going on. There I am. The 10-year, the PPMs are still pretty negative, -6.7, -57. But when we look at what that value was the other day, let me just bring this up so everybody can see this. If we look at that value the other day, the extreme, we were at 111, 1.11. Now we're at 167. You can see that all of these PPMs have actually turned up. And while they're still negative, they're starting to show, I just put some arrows here, all three of these have turned up. first signs of a bottoming phase. In this case, it's the first signs of rates stabilizing and about to start to move back up. As I've talked several times here, this is the weekly chart that we're looking at right now. You know, the big benchmark number that everybody's watching is the 3.03 level, which was the old highs that we saw earlier in the year. So that's the benchmark. We'll see whether we're a ways away from getting there, but we've got some work to do probably for the next couple months to see some stabilization of the interest rate market, which will ultimately get us to the pattern that will set up a move higher. So this is, I don't know if encouraging or not. If you're looking at a market bottoming, this is at least the signs. And then the big question out there that I'm still working on, don't really have an answer, is what does this mean for stocks? Is this the beginning of the topping phase of the market? I have said for, I don't know, maybe most of this year really, that the Q2 would be the point where a top would come into play. We continue to punch out historical highs. That's where a top comes. You're right. You know, you keep making new highs until you don't. And once you hit that high, then we'll be able to finally go. This was the high of the pattern. So the result of all this is really this is part of the process of starting to put in some of these extremes at this point, just so you can do that.
As far as the muni bonds, you could certainly use the ETF PZA. It's a PowerShares muni bond index.
Give me that symbol again.
PZA.
Incorrect. PZA. Let me try it again. PZA. There it goes.
Like pizza.
Yep. So yeah, this is interesting. Let me make that full screen. And this pattern that you can see, this has been going back to July. This is where these rates really started to bottom and start, actually to top out and start to move lower. The story that I saw this morning, I was just trying to look at my device here. I sent it to myself, and one of the things that I saw that was interesting is a lot of municipalities have been hesitant in bringing out new offerings. So there seems to be a shortage, which I guess if you're a municipal bond owner or a fund owner, that's what you want to see, because these prices are going to keep going up and yields will be going down, so it's all a good thing. And I saw another story somewhere over the weekend, there's something about mom and pop investors are back involved in municipal bonds, and most folks that are buying municipal bonds may be mom and pops, but they have a few more bucks than the average guy. So this is what's been going on. And the other phenomena that happened in the muni market was these Build America bonds that were out there, and a lot of states went to that. There was some tax advantages to the state, but investors and other folks didn't get any advantages, and it actually kept a lot of muni offerings off the street. And this goes back for the last several years now. And the municipal market is, you can see there was a huge hit back last year. There was a little bit of a scare, you might say, and that set up the reset for this particular model. Did you bring this up in VPM to see how we're modeling, what model we're using on this?
We're currently using the 3.2 system as the optimized system. And I think we're up 6%. Oh, no, excuse me. That's the, let me pull that back up.
Yeah, I got Mitch back on the screen, so.
Am I still Marlon Brando out of Superman? Just a floating head.
Not too bad. I mean, you can see a little bit, so it's not too bad.
All right, so on the 3.2 system, we're up 2.8%, whereas on the 1.2 system, we're up around 6%.
Yeah. Yeah, see, I have 3.2 on the screen right now, and let me just, let me check.
Yeah, that is the optimized one.
Yeah.
The other one is.
Yeah. So here's what 1.2 looks like. You can see right there above Mitchell's head. You've got the that is typical of this type of volatility. To see, I guess it's the end of the month. Mitch straightened me out last a few weeks ago. I said that we were re-optimizing our database the first, like today, and that doesn't happen until the end of the month, right, Mitch?
Right, July 1st.
Yeah. So anyway, so it's a good chance that there's some shifts going to go on in the database. That doesn't really mean much if you have a 1.2 or 3.2 model in your portfolio. I wouldn't go switching them. Unfortunately, in VPM 1.2, you can't switch models midstream. You're kind of stuck with that model, but overall, there's going to be very minor differences between the two in performance. Sometimes it's literally pennies, and it's a flip of a coin, which is the best, and most of the time that's the case. And the ones that are clearly mapped out to 1.2, 3.2 don't switch.
Right.
They just don't move around. So some of these that are pretty similar in performance, it is a flip of a coin, and sometimes it comes down to looking at these symbols when you're building your portfolios and looking at how the positioning of the actual trades look. Maybe there's some that meet more of what you would like to see versus what the optimized model is. I'd still go with the optimized, but at the time that you're looking at that. But so this pattern, this phenomena that's been going on in the munis for since last October now, working on a better part of a year, has been very real and has been part of this scenario that's going on out there, both in a shortage of paper as well as the just a general appetite that does appear to be coming back in for these municipal bonds. I mean, let's go to see what this index has as far as longevity, and let's go to the monthly graph. Not a lot. It goes back to 2008, but you can see during the crisis, nobody wanted to own a municipal bond because all the banks were going out of business, and it looked like the end of the world. So that's how everything got priced. Once again, it's the old blood in the street story. And if you went to that and bought those bonds, it was a great point to buy them. So right now we're just trying to get back up to toward the recovery high before the decline we had last year. So not a lot there on a monthly, and a daily is way too short term, but you can see how this trend has set up over the last, going back into the beginning of this year. There's been nice flow of capital going into these municipals. So going back to one of the things that we're trying to highlight during this area is treasuries, interest rates, and the dollar, and maybe some of the other currencies. Dollar's doing pretty good today. We're up 0.28. The index, dollar index, is at 80.59, and you're seeing some increase off the lows here. This is a daily chart. You can see that it looks like VPM 1.2 did buy this index here, and we're seeing the start to see these stair-stepping projections that come out of the projection tool, which tells me a lot about when these markets are going up. And you can just see that we had some higher prices projected there. Now we have another set of higher prices. There was a failed set right here where there was only one day when it broke out right here where I put the down arrow. That was some objectives. That pattern failed immediately. But a lot of times these ranges end up to be valid here, where I've got the X's going there. You can pretty much see what's going on there. So I got Mitch off screen. I can tell he's getting nervous and uncomfortable. Not really, but he was in my way. So, but these PPMs here you can see are all increasing, and this is a short-term daily. So if we go over and look at go to the intermediate, then on a weekly you start to see the same pattern that we've seen set up been setting up for a while actually. And I guess the best way to put this is that this continues to be in conjunction with the expectations, in my opinion, of higher interest rates. So if the bonds bottom last week at 240, which is very likely, then you can see this pattern here start to move up and start to see some appreciation in the dollar. And this dollar, you can see here, it's been range bound. As I drew some arrows here, it's been range bound for the last year and a half, and you could probably even extend that going back all the way back into 2012. And if we go to the monthly graph very quickly, you'll see a much more range-bound currency. It always amazes me how people over the last several years, especially the last 3 years, talk about how the dollar is collapsing in value. And I think it must be the gold hype artists that are putting that story out there, attempting to get people nervous. But when you look at the overall range of this, the top end range is really been identified back when, and all we've been doing is moving within this bracket. And so what we may be doing here now is moving back toward the top end of that bracket that I drew in. Whether we're going and doing amazing things on the upside, don't necessarily know that, but we are certainly starting to see some appreciation. But the currency has been stable for some time, and of course I've got to bring in my favorite currency, which is, I'm going to use the FXY, which is the Japanese yen. It's down today, but it's still maintaining. Let me get into a weekly mode. I still like this trade. It's still managing to stay in a flat pattern here. This pattern continues to be elongated and stable, and all of the indicators to me look like they still, this pattern wants to break out to the upside. So I'm continuing to hold this. I'm kind of going along with whatever VPM's telling me to do here. You can see there's a buy right here, and this pattern here I still think will start to move up 105 to 110 range, and at least get up to the range where we're at the top end of here. But more likely, let me just bring up let's do with the Fibonacci tools, let's do the retracement lines here. And this to me is really what the real story is here, is where the market's going to move up into this range. I know you can't really read the numbers here. I'll read them for you. But the best, I think the best way to build the right expectations for this is to look for it to go at least 50%, which is the 109. That's this line here, and then we're looking at 113 is 0.618, which is a Fibonacci. Minimum right here is 105.24. And I think ultimately you'll see it move it into these ranges here, and probably not exceeding anywhere up around the more extreme level. The very top line here is 119. I don't really see it getting there at the moment, but still think there's a very nice trade here where there's a good solid maybe 20-25% gain on this currency. So I continue to see that to be a good place to be. So at this phase of the show, I'll bring Mitchell back, and we will we'll start talking about. And one of the things I don't think I did. No, maybe I did. I did bring up. I got VPM up. I may have to re-log in here. And yep, I am going to have to log in. So bear with me 1 second here. Okay. I get Mitch and I back on the New York Stock Exchange while I'm doing some of this stuff. So So Mitch, I know I'm setting you up a little bit. So why don't you talk a little bit about some of the stuff that came through on the, and I'll have you up by the time you get into it as far as the weekly rotation and things of that sort happened.
Well, this week, when you look at the overall database, you'll see that there were more buys than sells. We had 572 net buys over sells.
You've got it on the screen now.
Okay. When I was looking over the database, and I was using the charts that we put on the main page, the sectors, the funds, the big thing that I noticed was that there actually wasn't a lot of shift one way or the other. When it comes to the stocks, it was pretty much just a 1% net buy across the board. There really weren't any particular sectors or groups that had concentration in either buying or selling. It was just pretty much a broad-based creeping to more exposure to the markets. When you look at the fund side, one of the things that I just want to draw your attention to, you'll notice that there is a little bit of spike on the sell side on the funds. And when you click on it, click on alternative funds, you'll see that there was some selling, but really that it wasn't necessarily concentrated. That alternative funds represents a lot of different mutual funds with a lot of different prospectus objectives. So, for example, there was some selling in the bear market, which is to be expected as we continue to get more invested on the equity side. It's not surprising. It's not necessarily always correlated. But it's not surprising that you're going to see some of the bear market positions sell off as we take a longer position on some of these positions. And then some of the various currency funds as well as the market neutral funds, you'll see also did have some selling as well. So that was pretty much the largest shift I would say this week that I happen to notice. There wasn't, unfortunately, any sort of broad-based sector or style box shift like we've seen in past weeks. It's just sort of been more of this creepy crawly as the market's moving a little bit higher, but still largely range-bound. We haven't seen any breakouts one way or to the upside or the downside on any of these sectors, style box, or asset classes.
Yeah, Mitch, I did start a glance if you want to. It's 9672. So.
All right.
Just so if you want to see actually what you're talking about.
Sure, that helps.
And control it. I did click on all the things that you were expecting to see while you're talking. But okay. I think one of the things I just want, well, Mitch is getting that going. I haven't enabled so you can drive, but I will do that right now. And you should be able to do that when you're in. But the bottom line is what's happening with the database continues. I keep bringing up the the death pattern, I call it, and it still is evolving. It still goes on. This in 2000 it occurred, but more importantly, back in 2007, it was even more prevalent when we saw the market going up and the participation level of the VPM database was less and less. And I guess I probably should maybe I'll log into 2.0. I didn't do that because I want to be able to go through a couple things there too, Mitch. So let me just do that real quick here. There, it's good. I'm already logged in, so that's good. So go back to the dashboard for you. So there. So anyway, as far as so the funds, as Mitch was just talking about, I was looking through these a little bit ago, and we really are as he said, there really isn't very little change there. If we go down to looking through all the funds here on general, there's no real new buys. They're pretty much status quo.
Right.
And that's going to be typical when you're looking at an index type strategy like a mutual fund or an ETF. You're going to have a basket of stocks there that are not likely to change very quickly, especially when the market's punching new highs out and there's a relative. I guess all the seas are rising, the water's all rising, bringing everybody with it at some level at different times, depending on what it is. Now, some of the style boxes, like down at Small Blend and all that stuff, they're pretty leaned out because we had a pretty good sell-off going in the small cap and some of the mid cap areas there for a while. Especially style box related as well. So let's go ahead. I had way too much fun talking about all this stuff today, and let's hit some stocks of the day, I guess. And
Okay.
let me get back over to that screen and clean up a few things here. And I've got us. So why don't you go ahead and give me the first stock here.
First stock is well.
1 second here.
All right.
This thing is not cooperating. There we go. Okay, first stock.
First stock. Let's do Whole Foods. It's been a while since we've talked about them. WFM. I still have yet to. Looks like you have some extra characters in there.
I do.
I still have yet to get any pizza dough from them, as you've referred
Yeah.
me to. But
Yeah. And that must be why the stock's acting like it is.
there you go. Yeah, it's just taking a nosedive. You see that on this one, we're optimized using the 1.2 trade system on this. We're currently flat. I believe we're flat both 1.2 and 3.2.
Yeah, that's 1-2 on there. Yeah, I'm sure we are on that. Yeah, so it's been a nice trade on that last trade. Bought it out right before the breakout and then finished it off over here. And now you're seeing this thing consolidate. One of the things that I could point out on this chart is that it is starting to see this consolidation. Typically, there'd be one more spike down and then the rally. But you are seeing, I mean, this is massive. Down almost 3%, down 1.5%, down 0.75%, rounding up a little bit from the PPM 1, 2, and 3. There's just a lot of pressure going on in the stock. This one isn't going to be one that we're going to need to think about much for a while. So let's go to next stock.
Next one is Starbucks, SBUX. I supported their Frappuccinos quite a bit on the drive back from Michigan.
I bet you did. So big trade here. And this goes to what I've talked about, what's been going on with VPM a lot, especially early 2014. We've seen a lot of these big trades that went back, into the third and fourth quarters of 2013 started and ran all through the year. As 2014 came in, we've seen a lot of profits being taken. And it's interesting because rallies like we saw last year, when you see these let's call them 25 to 30 percentile returns, what you get out of that is usually some really, really good tax efficiencies. And that's what we saw this year. We saw a lot of long-term capital gains being taken from VPM's viewpoint. So the tax efficiency levels were pretty high. And that typically is what happens during these trending years. In non-trending years, you tend to have more short-term profits and it's a little more choppy. But for the most part, when the big trend's there, you should be getting some nice traction and getting those long-term capital gains. They still count so far. Maybe that's the next thing to be attacked. But the bottom line is this pattern is actually setting up a pretty decent bottom here. And all that, and one of the things I haven't looked at, Mitch, but I'd want to do today, we got about 12 minutes to go. I would like to look at Apple just because Apple's got their big meeting going on right now.
Yeah, their developer conference today.
Yeah, I don't know if they've been any news out of that. Maybe while we're chatting, you can, I'll take you off screen so you can not look like you're trying to ignore us all. But this Starbucks pattern is interesting because it does look like it's bottoming and setting up a pattern that is likely to start to even generate a potential buy signal here. You've got PPM 1, 2, 3 all starting to accelerate. You're flat. You're still negative a bit on the on here, but it's improved a lot from its extreme. So this is pretty typical pattern that we're seeing on these PPMs here. As far as setting up a pattern to go up. So looks like maybe a retest of the highs would be in play at some point. I'm not sure. I'm guessing $80 some. I'll look at it exactly, but that's in play. So I guess
Yeah, I don't think the keynote has started quite yet for the developer conference.
Oh, okay. So we're down a little bit on Apple. I thought, yeah, it's 9:50. I don't know. Maybe it starts at 10 o'clock
10.
out
10
here.
starts at 10.
Yeah, on the. So we'll be off the air when that happens. But anticipation, as always with this stock, it's one of the heaviest and most followed stocks on Wall Street. I saw an interesting thing. If you would have, it was actually related to Donald Sterling's investment in the Clippers for I think he paid $40 million for it whenever he bought it, and he just sold it for $2 billion to another guy in the Billionaires Club, and they were comparing that investment to others, and I think he was right up there with doing some of the best investments that you could do, and then they ended up that the best trade was to buy Microsoft. It was, I forget, it was some ungodly 3,000 and some percent. I meant to have that story available for us this morning, but that was the best one. You were better betting on Bill Gates than you were Steve Jobs, and everybody perceives it to be different. And there was a lot more money made in Microsoft than there was in Apple. But regardless of that, we've talked about Apple potentially moving up toward to retest this old highs over here at 706, and that's certainly a possibility. And then you're going to start hearing all the analysts come out with the $1,000 plus deal. So let's see here, Mitch. So we got another stock then.
Yeah, let's talk about Amgen, AMGN, and that's currently using the 3.2 system.
Why didn't it change? Another one of those little glitches. So see if I can trick it.
GN, not ZN.
I know, but it's not nothing.
Oh, it's not taking it.
It's not taking it anyway. I'm not sure what happened there. Certainly should be. AM, give it to me now. AMGN, right.
Yep.
There it goes.
There we go.
Not sure what was going on. Okay, so this was another one of those, it's probably pretty close to long-term gain here, right at it. Another one of those trends that came out early last year that we're continuing to see exit, and now we're seeing a typical bounce off of here, where we're seeing the PPMs over here bottoming, similar to what we were looking at a minute ago, but you got a minus 0.3807 and a positive, so you got the 40-week moving average actually rising underneath the pattern, which is set up this stability. So my guess is you probably see a rebound back toward this. And it's interesting when you're looking at, if you did a lot of stocks, and we'll try to do our homework between now and then and look at the top, some of the S&P drivers, because that's one of the things I brought out last week, that I wanted to look at the stocks that are driving the S&P. So to make new highs on the S&P index and to continue to make new highs, it does not mean that all the stocks in the index have to make new highs, but if they all rebound, like Amgen we're looking at here, and it rebounds and just trades back towards its highs, and a bunch of stocks do that, guess what happens to the index? It continues to go up, and the breadth of the index does not have to expand. And that's one of the things I want to look at, and we'll do our homework by Wednesday's meeting, so we can get that going. So go back real quick and let's bring Mitch back on with us, and we'll talk about a couple things here. We got about 6 minutes to go. I think that the just like I expected, we probably have seen the low of the day. We tested the extremes of the day from the VPM target range, which was, the low was 1915.30, so we got down to 15.98, so we certainly held that and rallied back and stabilized. So I don't expect to see much more, and this week is going to be about the news, and the news is going to be about employment. So ADP is going to be bigger than than some of these small little manufacturing ISMs, non-manufacturing, and productivity reports. All that stuff isn't going to mean anything materially this week, I don't believe. Everybody's going to be having their eyeballs on the employment situation, so ADP, and then of course the employment numbers on Friday, which are expecting to be up one tick from 6.3 to 6.4. I really don't see, everybody's talking about the GDP number, the negative GDP that we had last week, being just weather related, which it probably was. Just how much was it weather related, and what do we see? So I think the next couple reports that we see are going to tell us more about what's really going on with the economy, and probably going to do more to affect any of the sentiment that we have looking forward. So I guess with 4 minutes to go, we could talk a little bit. Mitch and I are going to go back to the New York Stock Exchange here, I think, and get off the screens here a bit. I guess looking forward to some of the process warriors. Tomorrow we have process warriors. Last week we only did one, and I'm not sure what we had slated. Mitch, do you recall what we were?
Yeah, we're going to be talking about mutual fund and ETF, these index type strategies, how to construct a sound strategy. Some advisors approach it the wrong way, so we're going to show you some of the do's and don'ts around that, and also talk about realistic expectations for these, so that both you and your clients have the right expectations when you go into these strategies. So that's the name of the game for tomorrow.
Yeah, so I think we finish that up. We probably should start digging into understanding stats, going through fact sheets, some of the other elements that we have that are out there, and some of the tools that we have available to everyone, and just kind of see where that goes. And other than complaining about Mitch's white shirt, would you guys send us some emails and tell us what you want us to talk about specifically? Either show. I mean, we're here trying to provide information for you guys, not really trying to be the VPM entertainment channel, but we really want to do some really good things for you folks as far as understanding what's going on in the markets. The Market Thunder Show is about markets and about understanding things. And like I pointed out in going through the stocks, it really focuses how VPM handles a lot of these different patterns and things that are out there. There's nothing that's perfect out there from by any means, but the consistency of doing this, I've inspired some advisors on the street to become they got so smart they could do it on their own, and I've seen I know of a couple that aren't necessarily doing as good as they would hope. But one of the things that happens, the beauty of VPM, is that it is in a structured environment, and it's delivered in a quantitative environment that not I or anyone else is causing any kind of emotion. And most of the things looking at, like we've seen people using Dorsey Wright and just typical technical type patterns and moving average crossovers. It goes back to the lithograph that my old buddy, my partner Tony, used to have on his wall. It had the two professors with the complicated explanation, a little squiggly line in the middle, and it says, then a miracle happened, and then the answer. Unfortunately, that's what happens when you're doing a lot of technicals and on your own without it being in a quantitative model like VPM has been locked into. And the reason for that is it becomes more of a discretionary trade than a really quantitative trade. And even though most of the time maybe you're pretty disciplined, and you can really get yourself in a lot of trouble, because once you make the mistake, there's no recovery, and it's very difficult. VPM's been walked forward now since 1994 in an out-of-sample environment, so nothing that it's seen and will see from this point forward is going to be able to really affect how it thinks and what it does. So there's no magical input by me. So anyway, so we're looking forward to the Warriors this week, and we'll start digging into some of the fact sets, sheets and other elements, and PDC tool, and I think we already hit the cost calc tool, but there, all of this stuff is part of a pretty strong offering that we have put together to help you folks run your business in a very quantitative and structured manner. So anyway, Mitch, you have anything in closing? Your head just floats on the screen there.
Yeah, it just floats on the screen. I feel like I should be, telling my son, to follow the light or something like that out of Superman.
Maybe move your head around oddly. No, I'm just kidding. So, but anyway, folks, once again, it's time for the show to be over, and we appreciate the time that you give us. And whether you've just streamed this or whether you watched it live, we really do appreciate it. So, once again, have a great day, and we hope to see you tomorrow at Process Warriors. Same time, actually, 12 noon on Eastern time. We seem to have no problems. It definitely is a bandwidth issue. So have a great day, folks. Bye now.